During this week's New York session, at the exact moment Reuters confirmed that US Vice President J.D. Vance had announced a floor pricing framework for strategic minerals, silver prices were once again pressed below the $90 threshold. If you are holding US dollars, a silver-backed fund, or operating under the assumption that the price on the screen represents the true price, then this is the reality you are positioned within. In just the first 4 days of February, more than 14.8 million ounces of silver were demanded for physical delivery, a volume approaching 3 times the month's remaining open interest. On one side stands paper trading, seeking liquidity. On the other stands metal being actively removed from the system. When policy signals and physical flows begin to decouple, the relevant question is no longer how price fluctuates, but how long the notion of cheap silver can persist within the current monetary architecture, and what that implies directly for your capital. Immediately following that moment, imagine yourself not reviewing an end-of-day chart, but standing inside the New York session as it opens. Silver has just tested the 90 USD zone. Sell orders thicken, price action accelerates. Each upward attempt is swiftly pulled back. On the screen, the sequence resembles a familiar technical rejection. Yet behind those figures, a different process is unfolding, slower, quieter, and nearly invisible to anyone focused solely on price behavior. During this same window, silver is not returning to vaults. It is exiting the system, not through rumour or narrative, but through formal physical delivery requests. More than 14.8 million ounces in just the opening days of the month, during a period that is not even a primary delivery cycle. This figure is not dramatic in a sensational sense. It is abnormal in a precise technical sense. It exceeds the volume of contracts still outstanding. In practical terms, this means participants entering the market are not choosing to maintain exposure. They are choosing to take possession of metal and disengage. Once metal leaves the paper settlement framework, the phenomenon ceases to be a trading event and becomes something structural. It is precisely at this point that 2 distinct temporal regimes become visible. One operates on minutes and hours, where silver is sold as a financial asset in exchange for US dollars amid tightening liquidity and rising systemic risk. The other operates on weeks and months, where silver is treated as a physical asset intended to be held outside the system. These regimes are not contradictory, but they are no longer aligned. They do not speak the same language. And when a market begins operating in 2 languages simultaneously, structural tension is unavoidable. If one observes only price action during the New York session, selling pressure is evident. If one observes delivery flows, withdrawal pressure dominates. The sensation that something is misaligned emerges here, not because prices are falling, but because price declines are failing to produce the behavioral responses history would normally predict. Premiums are not collapsing. Physical supply is not flooding the market. Instead, metal is being withdrawn while price is being compressed. This signals that the market is no longer functioning as a unified mechanism. This is also why the New York session is frequently labelled as the venue where prices are suppressed. Yet this framing misses the underlying reality. New York is not where silver's intrinsic value is determined. It is where global financial stress is most transparently expressed. When equities, bonds and currencies come under simultaneous pressure, the system demands liquidity, and within the current architecture, the US dollar remains the primary settlement anchor. Paper silver, due to its liquidity, becomes a release valve. This observation says little about silver's long-term role, but it says a great deal about the current condition of the financial system. For this reason, silver's classification as a strategic mineral is not a peripheral detail. It is the element that clarifies the entire structure. When an asset is simultaneously liquidated as a financial instrument and protected as a strategic input, the market is forced into a contradiction. One side prices via leverage and short-term capital flows. The other prices via extraction costs, supply chain integrity, and economic security considerations. These valuation frameworks can coexist temporarily, but they cannot indefinitely overlap without generating friction. Here, the analytical stance of this channel becomes clear. Markets are not ultimately driven by price, but by actors who no longer possess optionality. Sellers during the New York session sell because liquidity is required. Those withdrawing silver liquidate contracts in order to obtain metal because they no longer trust paper claims. Neither action is irrational. Neither side is wrong, but only one is positioning for a horizon that extends beyond the next few trading sessions. When viewed through a global lens, this dislocation becomes even more pronounced. A common assumption holds that if US investors are not buying, demand must be weakening. In reality, physical accumulation across Asia and emerging economies continues, only it does not transmit its signal through daily price movements. For these actors, gold and silver are not profit-generating instruments. They are mechanisms for reducing systemic exposure. They do not require market validation through rising prices. Validation comes through possession of assets outside the credit system. It is here that the sensation of being inside an event becomes unmistakable. One is observing a market in which price charts narrate one story while physical flows narrate another. Neither narrative is false, but only one will remain intact when conditions shift. Monetary history repeatedly demonstrates that when physical assets are treated as financial instruments for prolonged periods, the eventual adjustment is rarely orderly and almost never unfolds according to consensus expectations. The most critical analytical task here is clarifying the true subject of the narrative. This is not merely a story about silver. It is a story about the US dollar as the world's liquidity center under increasing strain. A story about foreign currencies being pulled by interest rate policy. A story about gold as a traditional defensive anchor. And a story about silver, an asset positioned at the intersection where these tensions converge. The value of this analysis lies not in identifying price levels, but in enabling observers to recognize the structure they inhabit. If you have followed to this point, you have likely recognized a familiar pattern. This is not the first instance in which markets appear calm on the surface, while tension accumulates beneath. What distinguishes the present moment is that the signals are emerging simultaneously, from the New York session, from physical delivery flows, and from policy discourse. These signals do not provide immediate answers, but they pose a more consequential question, and it is that question that sustains attention. Are we observing a temporary distortion, or evidence that the framework through which silver is priced is becoming structurally outdated? Where does your perspective sit within this configuration? Leave a comment. It is divergence in interpretation, not hurried forecasts, that clarifies the narrative. And this is precisely why the question posed at the outset is not simple. When silver is being withdrawn from the system, while prices remain capped beneath familiar thresholds, the implication is that the market is not merely reacting to volatility, it is preemptively adjusting to a broader shift in monetary structure and policy orientation. Monetary history has repeatedly shown that when politics, fiscal dynamics, and supply chain security intersect, gold and silver cease to function as trading instruments and instead reassert their role as stores of purchasing power. This suggests that we may be at the early stage of a new cycle, one in which conventional notions of cheap and expensive lose relevance when divorced from policy context and physical flow dynamics. And this is only the beginning. In the months ahead, as frameworks surrounding strategic minerals are further defined, market behavior may continue to evolve, incrementally, quietly, but decisively. How do you think this will affect the US dollar, foreign currencies, gold, and silver over the coming quarters? Are we witnessing a temporary adjustment or a deeper reconfiguration of defensive assets? Share your perspective. This is Money Cycles, where we examine the foundational forces operating beneath the market surface. If you wish to continue following analyses of this nature, you know where to find us. What is unfolding today may not yet deliver a final answer, but it is clearly opening a set of possibilities that warrant serious consideration.